Hi, I'm Jim Jubak, and welcome to this Trend of the Week. My topic today is about Treasury notes, particularly 10-year, and volatility. I guess if you want to put it concisely, it's 10-year Treasury notes are tracking volatility. Okay, this is a chart of the Chicago Board of Options Exchange S&P 500 Volatility Index, known as VIX. It tracks volatility by looking at how much people are willing to spend to buy futures that hedge against volatility, either up or down. And as you can see, over the last month and a half, volatility has been really volatile. Fell all the way down here to about 15.10. That's actually slightly below the long-term average for the VIX. So at this point, you can say the market is really not very fearful at all, complacent, doesn't see any risk. But then what happens is we go zooming. We get the Omicron variant. We get statements from Jerome Powell, the Fed, about the Fed moving up its schedule for reducing purchases of treasuries and mortgage-backed securities, and the market sort of goes bananas, the combination. So we get a spike from where we were down here at 15 all the way up to 28 on the 26th of November, and then we actually go as high as 31 on the 1st of December. And then we plunge back down. What's interesting to me is to look at what's happening to Treasury yields during that period. There's been a lot of talk in the market about how Treasury yields are related to fears of inflation. So you would expect to see Treasury yields go up if people would demand more payment, if they're going to get more inflation, which would push treasuries down. I don't think that's what's driving treasuries right now in the short term. So back on December 1st, the treasury yield was 1.44 and the VIX was at 25.91. The VIX then climbed from 25.91 to 30.75 on the 3rd of December. Treasury yields went down, which means treasury prices went up because more people bought them. Because treasuries are a great hedge against stock market risk. As the VIX went up from 25 to 30, from the 1st to the 3rd, the yield on 10-year treasuries went from 1.44 down to 1.37. In other words, treasury prices went up because people wanted to buy treasuries because they were worried about the risk in the market. What's happened since then is that as the VIX has gone back down, treasury yields have gone back up because there's less demand, less need to hedge. So on the 7th, when the VIX was at 22, treasury yields have moved up from 1.37 on the 3rd to 1.46%. And then on the 8th, as treasury yields sort of stabilized around 22, the treasury yield actually rose a little bit more as treasury prices went down a little more. So we had a yield on the 10-year treasury of 1.52% on the 8th. I think this is a pattern that you're likely to see for a while. I think we're still too far away, really, from inflation and from Fed action for that to be the driver here. I think we're looking at a more short-term situation where the driver really is the need to hedge against stock market risk, because this is really a very volatile market. Okay, that's my trend of the week for this week. If you want more of my stuff, go to my free site, jubakpicks.com, to my paid site, 6 portfolios instead of 3, jubakam.com. And remember that we're running a sweepstakes where you can win free subscriptions to my paid site. That's $199 value for, as I say, free. So you find links to all that below. Thanks very much for watching.